Hello, welcome back to this week's market update. Today is Monday, July 1st, 2024, and last week marked the close of the first half of 2024. So we will jump right in with our market performance. The S&P 500 notched a new but very short-lived intraday all-time high on Friday as the PCE inflation report came in as expected. The S&P quickly reversed those gains, and you can see it ended negative on the week here with the S&P and Dow both down at 0.08% on the week, Nasdaq up slightly 0.24% on the week, and then the Barclays Aggregate Bond Index down about 0.7% as of last week. As we closed out the first half of 2024 last week, equities have shown some really strong performance driven by things like advancements in AI and technology, a stronger than expected US economy, as well as disinflation, the rate of inflation coming down. Year to date, the NASDAQ composite is the winner in these few indexes here, up over 18% for the year. The S&P 500 not too far behind, up about 14.5%. Then we have the Dow Jones Industrial Average up about 3.8%, so lagging behind those, but still positive. And then last but not least, the Barclays Aggregate Bond Index, that's down just over 2% in the first half of 2024. Hopping right into last week's economic news, we had the PCE inflation report come out on Friday morning, and this follows a very lighter than expected May CPI print, so a lot of the expectations were written down to reflect the lower than expected CPI print. With that being said, it came in as expected at 2.6% on both core and headline PCE figures, and both were down from the month of April. So here you can see we have been in a really strong downtrend of disinflation. That is, the rate of inflation has been slowing. Then when you look on a month-over-month basis, headline PCE was actually flat, and then core PCE, which excludes food and energy costs, that was up ever so slightly. So although there has been a few road bumps, you can see, a few months in 2024 compared to the end of 2023 did show a slight uptick in inflation. Overall, we are really in this downtrend, or at least we appear to be for now, of disinflation, and that is a really good sign. So along with the PCE inflation report, we also get some really great data on personal income, spending, and saving, kind of seeing how consumers are doing with their income, their spending, and their saving. So in May, you can see income, disposable personal income, rose 0.5%, so that's quite strong there. However, spending actually only increased about 0.3% in the month. So incomes went up, but spending went down. So this could mean people are prioritizing paying off debt, they are saving up more, maybe they're a little bit more cautious about the economy ahead, and that eventually caused the personal savings rate to tick up slightly to 3.9%, following it being around the 3.5 to 3.6% range in March. There you can see where it dipped down when spending was a bit higher than income. So overall, it's really just a balancing act of how consumers' income versus their spending and their saving is. And right here in the month of May, we saw that personal income rose more than spending, and that led saving to go up. Along with that, another measure of consumer behavior, consumer confidence here, we had the Consumer Confidence Index fall slightly in June due to rising concerns about future economic conditions. So you can see that small downtick right there in the month of June, and that has been in a slow downtrend really since 2021, 2022, where it peaked right after COVID. People felt good about the economy, they got stimulus checks, and ever since then, consumer confidence has kind of faltered. But you can see that is quite normal when you look at pre-pandemic norms, maybe around 2015 to 2017. That's pretty much the level that we've been at for the last year or two here. Consumers' assessment of their family's financial situation, both currently and over the next 6 months, was less positive. So a lot of write-in responses in the index showed that consumers were concerned about elevated prices, especially for food and groceries. Even though we have seen the rate of inflation really come down, that continues to impact consumers, as well as conditions concerns about the labor market and the US political climate. So, just a lot of concerns ahead for consumers, and that led to the small drop in confidence that we saw in June's index here. Another really important data point of last week, or a stress test to be more specific here. Every year since the 2008-2009 financial crisis, the Federal Reserve has performed a stress test, testing banks to see how they would perform in very adverse scenarios, adverse economic scenarios, maybe unemployment skyrockets, the value of properties go down, and sort of those sort of situations where it would kind of mirror the 2008-2009 financial crisis and those sort of economic conditions. And here you can see there were 31 participating banks of the stress test this year. So every other year they include the smaller regional banks. So this year was one of those years where they have all of the banks here reporting on their stress testing results to the Fed. And you can see in that all of the banks, all 31 of these banks here, did pass the stress test. However, the Fed did recognize that banks are worse off than they were a year ago, and that was primarily due to increased credit card balances. So you can see that here, as well as increased delinquency rates. So those have been ticking up ever since consumers got an influx of cash around the 2020-2021 pandemic time. But ever since then, we've really been ticking up to a higher delinquency rate and higher credit card balances in general. The Fed also noted that riskier corporate credit portfolios as well as loan downgrades have resulted in higher projected corporate losses. So, all of this comes to say that the banking system looks to be in fair condition. However, they did recognize that it is slightly worse off than it was a year ago. And finally, we have our economic indicator checkup here, where we had the Chicago Fed's National Activity Index. So that comes in right here. You can see it turned bullish as of last week. It is a measure of economic activity and inflation through factors like production, sales, orders, employment, and personal consumption and housing. So we got May's index here, and you can see the largest reason for May's index going up was an increase in production and income. So that's that big red block there, really led by production income, and that's what drove the index from negative territory in the last 2 months to positive territory in May. So overall, a lot of our economic indicators do look bullish. We have 5 bullish indicators, 2 bearish, and then 1 neutral. So overall, we still see the US economy performing well, being stable, maybe not as strong as it was a year or 2 years ago, but it still looks to be in decent shape. Thank you so much for tuning in to our market update this week, and we look forward to providing another update to you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.